So right now, the US housing market is in the biggest bubble of all time, even bigger than the 2008 bubble, and I think certain cities are going to crash by nearly 40%. And I know that sounds crazy to a lot of you. A lot of you think that we can't have a bigger housing crash than we did 15 years ago, but let me show you some data here that says we will. Take a look at this, everyone. We're taking a look at the last 130 years in America of inflation-adjusted home prices. And what do you notice? It basically from the 1890s all the way to the late 1990s, inflation-adjusted home prices were flat, basically meaning home prices appreciated at the level of inflation. Fast forward to today, entering 2022, in the middle of 2022, we have the highest ever inflation-adjusted home prices in US history, the biggest bubble of all time in 2022, even bigger than the peak of the previous bubble in 2005, 2006, which is all really important for you guys to remember. So we are in line now with Federal Reserve tightening, quantitative tightening, higher interest rates, and a recession to have potentially the biggest home value crash in US history. And that's supported by the data I just showed you from the Shiller Home Price Index, over 100 years of data saying we're in the biggest bubble of all time. But here's the catch. Not all areas in America are in a massive bubble. Not all areas of America are going to have a big crash. Meanwhile, other cities are poised for a 40% decline. And at this juncture of the housing cycle, it's not enough for us to predict that there's going to be a crash, because I think everyone knows that at this point. What we now need to do is predict how much the crash is going to be in different cities around America, so you all can have the data at your fingertips to understand when you need to get back into the market and when the true buying opportunities are going to present themselves. So that's what I'm going to cover in this video. We're going to take a look at the top 100 housing markets in America, and I'm going to show you how overvalued each and every one of them is and how much you can expect prices to decline. And really, if we take a look at a map here, we can see that the biggest bubbles are in the areas in red, which are predominantly in two places in America. One is in the Sun Belt. You can see particularly in the Southeast, there's a lot of red here. Like if we go to a market like Charlotte, we have a 27% decline projected by the Reventure Consulting home price model. And in this video, I'm going to give you guys detail exactly on how I came up with this model and why I'm predicting a 27% decline for Charlotte, as well as the other cities on this map. Meanwhile, if we go to the mountain regions of America, to a place like Salt Lake City, Utah, we can see a 28% projected decline. Or if we go to a place like Seattle, a 28% projected decline. And really, the thing that's driving these differences is it's not just random. These numbers aren't random. They are based off fundamentals. Three key fundamentals. The first one is home price trends historically. So take a look at New York City. Right here, we're taking a look at the last 25 years of home prices in New York, just what the nominal price of a home is each and every year in the New York metro area. Today, it's $600,000, and this includes the area of Manhattan, this includes the suburbs in Long Island, this includes the suburbs in Westchester. But what I want you to pay attention to is the yellow dotted line, because this is the home price trend historically in New York. And what you can see is today, in New York, we are above trend. So I am predicting home price declines in the New York metro area across Manhattan, across Long Island, across New Jersey. We're going to see that. But they're not going to be that large. For instance, they're not going to be as large as they were in the 2006 bubble to the 2012 crash. But let's compare New York now to Austin, Texas. And wow, you guys immediately see the difference, right? In the home price trend, in the home price bubble. Whereas New York, we're pretty close to trend, slightly above it. In Austin, current prices are way above trend. Like ridiculously above trends, meaning basically that what's going on in the Austin housing market over the last 2 years is a major deviation from the fundamentals that have dictated this market over the last 25 years. And this is a key point of why Austin's one of the largest housing bubbles in America, yet New York isn't. And if you compare the home prices of both of them on this graph, you can see that very clearly that, Austin was always way cheaper, and today it's about the same price. So understanding this home price trend is the first key point in the Reventure Consulting home price model, so you can understand how overvalued your housing market is and how much it's going to decline. This is one reason why I predict that Austin, Texas is going to have a 35% decline in home values. I think home prices are going to go from $594,000 down to $390,000 in Austin. Meanwhile, in the New York metro area, I'm only seeing an 11% decline in values. But folks, I know a lot of you are scratching your heads and you're saying, well, okay, that makes sense, but what about changes in the underlying economy? Right? Like, we can't just look at 25 years of history of home prices because these economies have changed, right? The incomes have gone up, the migration has changed. We need to start looking at some other fundamental indicators. And I'm going to get to your request in a second. I'm going to show you how much your market's going to crash in a second. But before that, it's just so important you understand why your market's going to crash. So you really have this fundamental understanding. And one thing you need to look at, in addition to home price trend deviation, is price to earnings ratio. How much home prices are compared to how much local workers earn in the economy. This is going to be a key telltale sign if your housing market's in a bubble or not. And one market that exemplifies this perfectly is Phoenix. Phoenix, Arizona. You can see here we're projecting a 27% home price decline for Phoenix. And why am I projecting this home price decline for Phoenix? Well, it's all related to the PE ratio, the price to earnings ratio in Phoenix. So let's take a look at this, folks. We got the PE ratio in Phoenix going back 15 years. And what do you see? Well, we see in 2007 the peak of the previous bubble. The typical home value is $273,000 in Phoenix. The typical earnings of the average worker were $34,000, so prices were 8 times what the average worker made, and that was at the peak of the last bubble. Then we had a big crash in home prices in Phoenix, where the PE ratio actually went all the way down to 3.3. In 2011, home values were $134,000 compared to $40,000 annual earnings. So interestingly, Phoenix went from being overvalued to being undervalued in the depths of the last crash. Then as it progressed, 2014 to 2019, Phoenix became fairly valued. The PE ratio settled around 5.5. And in this period, it was still probably a good idea to buy in Phoenix because it was still cheap. But then folks, take a look at where we are today in the Phoenix, Arizona housing market. We are back up to a PE ratio, a price to earnings ratio of 8.5. Typical home value of $466,000 compared to annual worker wages of $55,000. This means that the Phoenix housing market today in 2022, I want you to just be clear about this, is in a bigger bubble than it was in 2007. Worker wages and earnings are more stretched in Phoenix today than they were back in 2007, which means I think we're going to have a big crash in Phoenix on the order of 30%. But let's provide some context here. Let's add Richmond, Virginia to this graph so you can get some idea of what a market that's not in a major bubble looks like. Richmond's the blue line. The PE ratio today is only 6x, well below what it is in Phoenix, meaning locals in Richmond who earn almost as much as locals in Phoenix can much more afford the home prices. Additionally, what you see here in Richmond is that not only is the PE ratio lower, not only is it lower, this is so important for you to understand, it is stable. It's basically stayed in this range of 5 to 6 over the last 15 years. And so this is why a market like Richmond, Virginia, I'm only projecting for a 12% home price crash because the locals in Richmond can still afford the homes. This is such a key point. The locals can still afford the homes. Whereas if you go to Phoenix and many of the other markets in red that are in big bubbles, the locals can no longer afford the home. And this is another telltale sign of a bubble, this elevated price to earnings ratio. And it's why Phoenix is going to have a big crash. It's why Utah is going to have a big crash. It's why Denver is going to have a big crash. It's why Dallas is going to have a big crash. But folks, there's one more thing. There's one more input to this model that you all need to understand. I'm sorry if I'm getting technical here and I'm going long before I get to your request, but I just Really want you to understand the fundamentals so you know I'm not just making these numbers up. They're based on what's going on in these local economies. And the last thing we need to talk about is price to earnings ratio. This is the last input in the Reventure model, looking at how much rents are in the market, how much yield investors are getting when they buy homes, because this is really the final, let's just say, nail in the coffin of a housing bubble market. And to illustrate this, I want to talk about Seattle, Washington. Let's take a look at Seattle. I'm projecting a 28% decline in home values in Seattle from 792,000 to 570,000. Why am I projecting that decline in home values in Seattle? Well, folks, Seattle is off trend, price to earnings ratio is high, but in addition, price to rent ratios in Seattle are off the charts. So if we see here, in the spring of 2022, the typical home value in Seattle is $792,000. The typical annual rent is $26,000, meaning that the typical price is 30 times what the annual rent is in the market, which is yet another sign of a big bubble. It means two things. It means, one, investors who are buying in Seattle get a very low return, a very low yield. It also means that a home buyer, a future home buyer, is going to be much more likely to choose to rent in the future because it's way cheaper to rent. But really, it's not just the fact that this is high, this PE, price to rent ratio, it's that it's above the long-term average once again. And for this PE ratio to go from 30 back down to 23, which is the long-term average, we would need to see a 24% decline in home prices in Seattle. So this is really how this model works. We're saying how much are home prices needing to go down to get back to the long-term levels dictated by fundamentals. And to give you a comparison here, I want to compare Seattle to Albany, New York. Because we're comparing a market like Seattle that's very overvalued, PE ratio is 30, to Albany, where the PE ratio is only 15. The typical home value in Albany is $262,000. The rent is $18,000. And we can see 15, not only is that much lower than Seattle, meaning that Albany is way cheaper, relatively speaking, but we also see Albany has stayed stable. It's stayed in this range of 13 to 15, going all the way back 7 or 8 years, which is why I'm projecting Albany only for a 13% decline in home values compared to a 28% decline in Seattle. So get your requests ready, folks. I'm going to transition to taking your requests in 1 second. But before getting into that, I just want to let you all know that these home price crash predictions, I view these as a positive sign and a positive development for the housing market. There's a lot of people out there who watch my videos and they say, Nick, why are you so negative? Why are you so negative on the housing market? I'm not negative. Home values in America, they need to go down to restore some type of fundamental order and balance to society and the housing market. It's not good that home values are so high right now relative to wages and rents. It means that people are really being stretched thin in their ability to afford homes, afford the American dream. So I want to encourage a lot of you, in case you aren't already, to look at these home value crash projections as a positive development. I know a lot of people who are real estate investors and realtors will struggle with that concept because they're so used to thinking that, oh, home values just need to go up. No, they actually need to go down from where they are right now to return American society to a more equitable place where a wider range of people have an opportunity to participate in the U.S. housing market. So with that, everyone, let's get some requests. My channel members are making the request here. If you want to request, everyone, you're not a channel member, hit the join button below. There's also a link in the description to become a channel member. So what markets do you want me to look at, all folks? We're getting a request for Atlanta, so take a look at Atlanta, everyone. I'm projecting a 25% decline in home values in Atlanta from a typical value of $370,000 down to $275,000. And the big driver in Atlanta of this crash projection is related to a decline in affordability. So if we take a look at the price to earnings ratio in Atlanta, it's 6.7 right now. Home values are nearly 7 times what the worker earns in a year, whereas the long-term average is 4.3. So we need values to come down by about 25 to 30% to get back to this long-run average. And I think it's going to happen sooner than later, especially as investors in Atlanta sell out of the market. All right, everyone, what other markets are we going to take a look at? How about Columbus, Ohio? Let's go to the Midwest, and we can actually see that Columbus is one of the higher crash projections I have for the Midwest. Like, it's only at 19%, which is obviously much lower than in Austin, Texas, but you could see Columbus is in a reddish color compared to a bluish color for a lot of the Midwest. So I'm projecting home values to go from 290 to 234 in Columbus. Why is that? Well, again, maybe let's take a look at the trend in home values this time in a market like Columbus. Over the last 25 years, why are we projecting a 19% decline? Well, you can see here we are a fair bit above this 25-year trend line in Columbus home values. So we're going to see values come closer to this trend. They're going to come down, I think, 15 to 20%. It's not going to be a major crash, and in the long run, I think Columbus is still a good market to invest in, but expect a bit of volatility. Now, let's move on over to the West Coast. Let's look at San Diego, everyone. San Diego is a market where, I have a lot of people in San Diego. And take a look here. We're projecting a 22% decline in San Diego home prices. I mean, take a look at how expensive San Diego is. The typical home value is $923,000. I'm projecting it goes down by 22% to $723,000. So, we're going to see a crash in San Diego, but that crash, as is the case in a lot of California, we're going to see a crash, 15, 20%, but it's not going to all of a sudden make California cheap. It's just going to make it more affordable than it used to be, which is of course going to be welcome news to a lot of you, everyone. So, okay, what other requests do we have, folks? Someone's asking about Orlando, Florida. How about Orlando, Florida? This is a market that, like San Diego, I am projecting a 22% decline in home values in Orlando. This is a mixture of prices being above rents, prices being above wages, prices being above long-term historical trend. And, since we're on Florida here, I actually just kind of want to zoom in here and knock off these Florida markets one by one. We can see here Orlando, 22% decline. But if we go to Tampa, I'm projecting 27%, because Tampa is a market that's super frothy right now. Lots of investors, lots of home building, lots of flipping, and the rents are out of control. I think there's a rent bubble in Tampa, and I think values are going to go down by 27%, as they are in a market like Northport, Sarasota, as they are in a market like Cape Coral, Fort Myers, as they are in a market like Port St. Lucie. Now, interestingly, we got to bring up Miami, because you can see Miami is the best projection that I have for Florida. I'm only seeing a 16% decline in home values in Miami, and the reason being is that the rents in Miami are so high that the rents actually support where current home values are. However, the earnings and the wages don't, which is why I think Miami is going to have a downturn. I just don't think it's going to be as bad as some of these other markets. All right, everyone, let's keep it rolling. Let's get your requests ready. If you want to request a city, make sure you're a channel member. Hit the join button below and I'll get to your request. Let's get a request for Las Vegas, everyone. Las Vegas, I'm seeing a 23% decline in Vegas. Values going from $437,000 to $334,000. So why am I predicting this decline in Vegas? Well, let me show you, folks. It's going to be very obvious when we look at the long-term price to earnings ratio graph. And the reason I'm showing you these graphs, folks, is because I want you to understand not just my prediction, but why I'm making these predictions. So at the peak of the previous housing bubble in 2007, the value to earnings ratio was 9.8. And we could see in Vegas it then crashed down to 3.9, which again meant that Vegas was actually undervalued in 2012. So the great thing about this metric, folks, price to earnings, is you can actually use it as the crash plays out. You can use it to figure out when a market becomes overvalued. But then, bam, we have now shot back up to 9x PE ratio, where the long-term average is 6x, which means we're going to have value declines in Vegas, especially given all the speculation, home building, and investor demand in the market. It's not going to be as bad a crash as last time, but it's going to be pretty bad, if you ask me. All right, everyone. What else do we got? Get your requests ready. What do we got? How about Tulsa, Oklahoma? Interesting request, Tulsa, Oklahoma. This is a market that I love, actually. It's one of my favorite ones in the U.S. housing market. You can see here the typical home value in Tulsa is $205,000. I'm projecting a 17%, don't know whether you call that a crash or a correction, but a 17% decline down to 170,000. I'm actually was surprised. I wasn't expecting my model to project Tulsa at a 17% decline. I was expecting more like 10%. However, I'm still bullish on this market long term. There's still good cash flow yields. If you want to move to Tulsa, they'll pay you $10,000 to move there, which could help buffer maybe some of the value decline if you buy. All right, everyone, what do we got next? We got a great question actually coming from Pablo. He asks, do you think it would be, he asks, what do you think the pressure is going to be on values once the FOMO takes over? And that's a great question. I'm going to get to more of your requests in a second, but we need to talk about the FOMO here. Because right now the FOMO has shifted from the buyer to the seller. And so the sellers are now going to be cutting prices and rushing to market. And I think that means we could actually see values go down by more than my model projects. But a lot of that is going to depend on the associated economic downturn that happens. Like, for values to really go down by even more than my model is predicting, we're going to need to see a big economic downturn in a city like Vegas or Austin. That's kind of the only way that we can get to, say, like a 2008 level of a 50 or 60% decline, is you really need like a brutal local recession, which could happen in certain markets. Like, I think in California, I think my model kind of went easy on California. We're seeing here 20% value decline in Riverside, 22% in San Diego, 16% in Los Angeles, 18% in Oxnard, 21% in San Jose. I wouldn't be surprised if the California crash is bigger than my model predicts, because the one thing my model doesn't take into account is the economic risk factors. And for instance, like if we go to San Francisco, a large portion or majority of the portion of the housing market demand there comes from tech-driven demand. So if we have a big tech crash, I could see values going down by a lot more than this. All right, everyone, let's keep the request train rolling. Let's keep it rolling. We got a Portland, Oregon request, which again, kind of like California, I'm thinking maybe this is a little light, but the model is saying an 18% decline in home values in Portland from 581,000 to 477,000. And so again, Portland is this kind of tech-driven housing market that I think could go down further than the model predicts, but the baseline projection is 18% in Portland. And then Landy wants to see St. Louis. Thank you for the super chat, Landy. Let's move over to St. Louis, which is in the Midwest. And more broadly, everyone, before we get into St. Louis here, you could see the trend on this map, right? Where the Midwest is in blue, the Northeast is in blue, meaning my model, the Reventure Consulting home price model, does not predict as big a value decline in these areas, but it's still predicting a 14% correction in St. Louis, down from 239,000 current value according to Zillow to an adjusted price of 206,000. And in a market like St. Louis, this downturn, and it's really important you all understand this, that this is an average projection for an entire metro area. So there's going to be deviations in different neighborhoods. In St. Louis, some neighborhoods are going to be above 14%, others are going to be below 14%. And one thing you need to pay attention to, I've talked about this a lot, is poverty rate, investor demand. Those are two big things. The higher the poverty rate and the higher investor demand in your city and your neighborhood, the more that we could see a decline. So I could see like St. Louis, certain neighborhoods having potentially a 30 to 40% decline that are high poverty, high investor, but then other neighborhoods only having a 5% decline in St. Louis. All right, everyone, what else do we got? What other requests do we got? Keep them flowing in. Philadelphia from Donna. She wants to see Philadelphia. So Philadelphia is a 15% crash projection, going from 327,000 typical price to a 278,000 typical price. And again, I want to show you all why I'm not projecting Philadelphia for as big a decline. And the reason is, if we look at the price to earnings ratio, we can see, again, we're pretty close to the long-term average. The long-term average ratio of home prices to how much workers make is 4.9. We are at 5.8 today, so we are above average. We're going to need to have a correction in Philadelphia, but it's not going to be the type of correction that we would see, in a place like, let's take a look at Boise, Idaho, so you guys can see what a real bubble looks like. Whoo boy! This is Boise, Idaho, price to earnings ratio. We're all the way at 11x compared to 6x historically. So this is what a major bubble looks like. Philadelphia isn't as big. If we go to a place like in El Paso, Texas, I'm seeing a request for El Paso, Texas here. You can see it looks kind of like Philly. We have a long-term average PE ratio of 4.5. We're up to 5.6 today. Homes are still so cheap in El Paso, typical value of 188,000. So we'll have a correction in El Paso, but we're not going to necessarily have a crash. Another market where I do think we could have a crash, though, is Raleigh, North Carolina. So let's keep these requests going. In case you guys want to request, make sure you're a channel member, hit the join button, and I'll get to it. Raleigh's PE ratio today is 8.4 compared to a 5.5 long-term average. And this is what's scary about Raleigh, everyone. So we're at 8.4 today. Typical home value of 445 compared to annual earnings of 53,000. Back at the peak of the last bubble in 07, Raleigh's PE ratio is 6.3. So we're way higher in Raleigh today than we were at the peak of the last housing bubble, which is a big problem in a market like Raleigh. As it is in a market like Spokane, Washington. I'm going to get back to the map in a second, folks, but let's keep going on PE ratio. Spokane, PE ratio is up to 8, higher than it was at the previous bubble in 07-08. So this has got to scare you, everyone. And I'm not trying to scare you, but when the data is saying that home prices in your market are higher than they were relative to wages in the 2007 bubble, you got to stop in your tracks. You got to stop in your tracks if you're a home buyer. And if you're a seller, you better get your house on the market, because there's this delusion that a lot of people don't think we're going to have the same type of housing crash this time that we did 15 years ago, at least in terms of value declines. And the answer is yes, we will, folks. The average home price decline in America in this crash will be very close to what it was last time. The thing that's going to be different about this crash is that we're not going to have as many foreclosures. We're not going to have as many people getting kicked out of their home, which is good news. But because the Federal Reserve has artificially inflated values for over a decade, now that they're increasing interest rates and doing quantitative tightening, we're going to see, I believe, the same type of value declines this time as we did in 07. So that's something you got to really be paying attention to, everyone. Okay, let's get back to some more requests here, folks. What markets do you want me to cover, everyone? We've been doing good so far. We got a request for Colorado Springs. So let's do Colorado Springs. 25% value decline I'm predicting in Colorado Springs, which you can see is pretty close to the 22% in Denver and the 21% in Boulder and the 19% in Fort Collins. And the reason is, again, the same. If we look at the earnings ratio in Colorado Springs, it's ridiculous. But really, where it gets ridiculous, let's go back to rents. Because someone was asking about the high rents in this era. And folks, the way to think about rents is they're not high relative to prices. Like in Colorado Springs, the long-term average price to rent ratio is 18. Today it's up to 23. So the typical home value is $486,000. The annual rent's $21,000, a 23x price to rent ratio. So while rents might have gone up, they haven't come close to keeping up with prices, which means that a market like Colorado Springs, as well as many of the others on this list, are in a big bubble. You better believe it. You better get on the program with this, folks. How about we go to another request here, Honolulu. Honolulu. A lot of people complain I don't cover Hawaii enough. Well, I'm going to cover Hawaii right now. And you can see Hawaii is very expensive. The typical home value is $916,000. The typical annual rent is $31,000. So that's an amazing 30x price to rent ratio. It almost hurts my eyes to look at that. But we can see the long-term average is 26. So I don't think Honolulu is necessarily going to have a major crash. Let's see. Do I have it here? Where's Honolulu? There it is. I'm projecting a 12% home value decline in Honolulu, going from $916,000 to $805,000 in Honolulu. So let's keep this going. Let's keep this going. What other requests do you have, folks? I have time for probably 5 to 10 more. What do we got? What do we got? I apologize if I haven't gotten to yours yet. Let me know. Someone's requesting Albany. Already covered Albany. Someone's requesting Billings. I saw Billings in Missoula, Montana. So unfortunately, they're not on this because they don't have rent projections from Zillow. But let's take a look at price to earnings ratio in Montana, because we do have that data. So let's take a look at price to earnings ratio in Missoula. Yeah, and this is scary, folks. This is scary. We're at a 13x price to earnings ratio. The average worker in Missoula makes $42,000. The typical home value is $566,000. That's 14 times what the average worker makes. The long-term average is 9. So Missoula is going to have a brutal crash. Missoula is going to have a brutal crash. As are a lot of these markets on the western half of America. But interestingly, I got to pivot back now. Before I get to the rest of the West Coast, we got to talk about Texas. Dallas, city I live in, the city I know a lot of you live in. I'm projecting a 24% value decline for Dallas, going from a typical value of $381,000 to an adjusted price of $288,000. That's a big crash. Dallas has never had a housing crash that big in its history. It's going to have one now because it's in such a big bubble. Houston and San Antonio, I'm seeing 20% declines, not as bad. And then Austin's a 35% decline. So Texas, it dodged the last housing bubble. It's not going to dodge it this time. Houston's the one market that I think could outperform because it's heavily reliant on oil, and the oil industry is obviously booming right now, at least in terms of profits. So Houston's economy might perform better, which means maybe we get less than a 21% decline in values in Houston. All right, everyone. I'm seeing some requests for cities I already covered. So if I don't get to your request, make sure to go back and rewatch this video. So you can see the cities I already covered, like I covered LA, I covered a couple of other these markets. Miami, Beatrice is requesting Miami. So I covered that a bit earlier, but let's just talk about it again real quick. 16% value decline projection in Miami, which is actually my lowest crash projection in Florida. And again, the reason is because the rent is really high in Miami. How about we get a couple more requests, everyone? Greenville, South Carolina. Let's keep it moving. 20% projection for home value declines in Greenville. Greenville, 20% projection decline. We talked about Raleigh. We got a 28% projection in Durham for crash potential. We got a 27% projection in Charlotte. We got a 23% projection in Knoxville, Tennessee. We got a 25% projection in Nashville. So you can see pretty much all of this cluster in the southeast is projected to go down. All right, Boston, Worcester, good request. I used to live in Boston. We're getting a 15% crash projection for Boston. This one I think might be somewhat conservative given the fact that Boston has a heavy tech reliance, and if tech continues to go down in terms of the economy and layoffs, I think Boston's housing crash could be worse than 15%, but that's what the model is saying right now in Boston, similar in Worcester. Someone's asking, how long do you think, someone's asking, how long do you think it will take to go from peak to trough in the Bay Area? Where I'm projecting 17% in San Francisco, 21% in San Jose. That's a great question. So let's just talk about timing real quick, because this is how we're going to end this video, is talking about timing. Last housing crash from 2007 to 2012 took 5 years to go from peak to trough. I do not think this crash will take nearly as long, simply because the run-up in values happened a lot faster. And now that the Fed is aggressively tightening monetary policy and we're walking into a recession, don't be surprised if the value gains over the last 12 to 18 months get erased in the next 12 to 18 months. So I think we're going to have a much more accelerated crash this time around, where maybe in the first 12 to 18 months we have pretty big price decline, and then over the next 12 to 18 months, like over 3 years, we have an incremental decline in prices. So maybe 3 years peak to trough in this crash as opposed to 5 in the previous one. That's what I'm speculating here. So this is going to happen a lot faster than I think a lot of people believe. We're already seeing that with the inventory skyrocketing out of control right now across many parts of America, and the price cuts getting very, very epic. All right, everyone, I'm going to take 2 more requests and then I'm going to sign off. What markets do you want me to end with? Let's look at Louisiana. Someone's requesting Louisiana. All right. You can see here, Baton Rouge, I'm only requesting predicting a 10% decline, and New Orleans an 11% decline. So these are actually 2 of the lowest crash predictions I have, and the reason is because the prices are more closely aligned with rents and earnings. So we're not going to see as big a decline in these Louisiana markets. They haven't appreciated as much going forward. And then to finish it off, let's do Jacksonville, Florida. 23% crash projection in Jacksonville, Florida, as well as a 25% projection in Daytona. And I talked about these other Florida markets earlier in the video. Guys, if I didn't get to any of your requests in this video, I will get to them on the members only community board. So tomorrow I'm going to make a post on the members only community board, and if I didn't get to your request, make sure to leave a comment in that post tomorrow. The key takeaway here is the housing crash has started, home prices are the highest they've ever been, and it's going to be brutal, it's going to be bad, but this is going to be a good thing for the US housing market and society going forward. All right, everyone, until next time, this is Nick from Reventure Consulting signing off.